Hey, welcome to Smart Money Finance. Have you ever wondered how legends like Rakesh Jhunjhunwala or Warren Buffett built their massive wealth through the stock market? Or why some people make consistent profits while others lose everything? Are you confused about candlesticks, bulls, bears, or even where to begin? Today, we're not just scratching the surface. We're diving deep into the world of stock markets with a complete guide that will take you from a total beginner to a confident investor. Grab your notebook because this will be a masterclass. Oh, and this is just part 1. Subscribe now so you don't miss part 2, where we'll dive even deeper into strategies for taking your first trade, risk management, and mastering the mindset for trading. Let's start with the obvious question. Why should you invest in the stock market? 1. Inflation is your enemy. Inflation erodes the purchasing power of your money over time. In India, the average inflation rate hovers around 6 to 7%. This means that if your money is sitting idle in a savings account earning 3 to 4% interest, it's actually losing value. By investing in the stock market, you have the potential to earn returns that outpace inflation and grow your wealth. Wealth creation. The stock market has been one of the most powerful tools for long-term wealth creation. For example, the Sensex, India's benchmark index, has grown from around 100 points in 1980 to over 60,000 points today. This incredible growth showcases the power of compounding and the opportunities available in the stock market. 3. Financial independence. Investing helps you build a passive income stream, freeing you from the need to rely solely on your salary. Over time, dividends, capital gains, and reinvested returns can create a financial cushion that allows you to pursue your dreams and goals. 4. Real-life success stories. Consider Rakesh Jhunjhunwala, often referred to as the Warren Buffett of India. He started with a modest sum of 5,000 rupees and turned it into a multi-crore portfolio through disciplined investing and a deep understanding of the markets. His journey is proof that success in the stock market is achievable with knowledge and patience. Before jumping into strategies, let's cover the basics. Here's what you need to know. 1. What is a stock? A stock represents a share of ownership in a company. When you buy a stock, you own a small piece of that company and are entitled to a portion of its profits, which may be distributed as dividends. Stocks are traded on exchanges, and their prices fluctuate based on supply and demand. 2. How does the stock market work? The stock market operates as a platform where buyers and sellers trade stocks. In India, the primary stock exchanges are the Bombay Stock Exchange, BSE, and the National Stock Exchange, NSE. The stock market is influenced by factors like company performance, economic conditions, and global trends. 3. Key players, retail investors, individual investors like you and me, institutional investors, large entities such as mutual funds, insurance companies, and foreign institutional investors, FIIs, that trade in large volumes and can significantly influence market movements. 4th, bull versus bear markets. A bull market occurs when stock prices are rising, indicating optimism and economic growth. Conversely, a bear market is characterized by falling stock prices, reflecting pessimism and potential economic downturns. Both market conditions present unique opportunities for investors. 5. Stock market index. A stock market index, such as the Sensex or Nifty, tracks the performance of a group of top-performing companies. These indices serve as benchmarks for the overall health of the stock market and help investors gauge market trends. Now let's get technical. Understanding candlesticks is crucial for reading stock market charts. 1. What is a candlestick? A candlestick is a type of price chart that shows the opening, closing, high, and low prices of a stock during a specific time frame. It provides a visual representation of market sentiment, helping traders analyze price movements. 2. Components of a candlestick. Body. The rectangular part of the candlestick represents the opening and closing prices. A long body indicates strong buying or selling pressure. Wick, shadow. The thin lines above and below the body show the highest and lowest prices during the period. Color. A green or white candlestick indicates that the closing price was higher than the opening price, bullish, while a red or black candlestick signifies a lower closing price, bearish. 3 types of candlesticks. 1. Doji, a candlestick with a very small body, indicating indecision in the market. It often signals a potential reversal. 2. Hammer, a candlestick with a small body and a long lower wick, suggesting a bullish reversal. 3. Shooting. Star, the opposite of a hammer, indicating a bearish reversal. 4. Engulfing patterns, when a larger candlestick completely engulfs the previous one, signaling a strong reversal. 4th. Chart types. 1. Line charts. This show only closing prices over time, making them simple but less detailed. 2. Bar charts. It include open, high, low, and close prices, offering more information. 3. Candlestick charts. The most popular choice for traders due to their detailed and visual representation of price movements. Do you know Harshad Mehta, famously known as the Big Bull of Dalal Street, leveraged technical analysis to predict market movements? While his story had ups and downs, it's a testament to the power of understanding market patterns. Let's now talk about the different types of stocks and investment options. 1. Large cap stocks. These are well-established companies with a market capitalization above 10,000 crores. They are considered stable and reliable investments. Examples include Reliance Industries and TCS. 2. Mid-cap stocks. These companies have a market cap between 2,000 and 10,000 crores. They offer a balance between growth and stability, making them ideal for moderate-risk investors. 3. Small-cap stocks. Companies with a market cap below 2,000 crores fall into this category. They are high-risk, high-reward investments, often suitable for aggressive investors. 4. Blue-chip stocks. These are financially strong and stable companies with a history of consistent performance. They are often leaders in their industries, such as HDFC Bank and Infosys. 5. Penny stocks. These are low-priced stocks of small companies that carry high risk. They can deliver massive returns, but are highly speculative. 6. Mutual funds and ETFs. Mutual funds pool money from multiple investors and invest in a diversified portfolio. ETFs, exchange-traded funds, are similar but traded like stocks on an exchange, offering liquidity and transparency. 7. Sectoral funds. These funds focus on specific sectors like IT, pharma, or banking, providing targeted exposure to particular industries. Now that you understand the basics, here are the steps to get started. 1. Choose a brokerage account. Selecting the right brokerage is crucial. Look for platforms like Zerodha, Upstocks, or Grow that offer low fees, user-friendly interfaces, and robust research tools. 2. KYC process. Complete your Know Your Customer (KYC) process, which involves submitting identification and address proof. Most platforms allow you to complete this online within minutes. Start with small amounts. It's wise to begin with a small investment, such as 500 rupees, to familiarize yourself with the market without taking on significant risk. 4. Use demo accounts. Many platforms offer paper trading accounts, enabling you to practice trading with virtual money before investing real funds. 5. Follow market news. Stay updated with market trends and news using apps like Money Control, Economic Times, or Bloomberg. Understanding current events can help you make informed decisions. If you're enjoying this, hit like and subscribe. Don't forget to share this video with your friends who want to start investing. And remember, Part 2 will dive into taking your first trade, risk management, and mindset. Don't miss it. Here are some advanced strategies for those ready to take it up a notch. 1. Portfolio diversification. Spread your investments across different sectors, asset classes, and geographies. Diversification reduces risk by ensuring that a downturn in one area doesn't wipe out your entire portfolio. 2. Stop-loss orders. Set a stop-loss order to automatically sell a stock when it reaches a certain price. This minimizes losses and protects your capital during volatile market conditions. 3. Fundamental analysis. Evaluate a company's financial health by studying its balance sheet, income statement, and cash flow. Key metrics include the PE ratio, return on equity ROE, and debt-to-equity ratio. 4th. Technical analysis. Analyze price charts, volume trends, and patterns to predict future price movements. Tools like moving averages, RSI, Relative Strength Index, and Bollinger Bands are commonly used. 5. Hedging with derivatives. Use options and futures contracts to hedge against potential losses. These instruments can protect your portfolio during market downturns or uncertainty. And there you have it, your complete guide to investing in the stock market. This is just part 1, covering all the basics you need to know. Watch this carefully, and you won't have to watch any other video about stock market basics. In part 2, we'll dive deeper into how to take your first trade, manage risk, and master the trading mindset. So subscribe now and stay tuned. Remember, investing isn't about timing the market, it's about time in the market. If you have questions, drop them in the comments.